Okay, let's go ahead and talk about cases where the subsidiary has other comprehensive income, and we'll see how that affects our consolidation process. Now, when a subsidiary reports other comprehensive income, it adds another wrinkle to our consolidation process. First, we have a few general principles that should be guiding what we're trying to do. First, the other comprehensive income on the comprehensive income statement gets closed to accumulated other comprehensive income on the balance sheet, part of owner's equity. So it really parallels what goes on with net income and retained earnings. So basically we have sort of our regular income being funneled through to retained earnings. We have our other comprehensive income being funneled through to accumulated other comprehensive income. The accumulated other comprehensive income, which I'll simply call AOCI from now on, presented in the owner's equity section of the balance sheet, is the parent's accumulated other comprehensive income. So if we have an 80% owned subsidiary and the subsidiary has $100 of AOCI, then the parent would report $80 of AOCI. And since the consolidated balance sheet is prepared from the point of view of the parent company shareholders, the AOCI on the balance sheet would be $80. The other $20 of that would be funneled to the non-controlling interest account. So that means that the entire $100 of accumulated other comprehensive income shows up in the owner's equity section, $80 of it explicitly as AOCI, the other 20 sort of rolled into the non-controlling interest account. On the statement of comprehensive income, the entire other comprehensive income from the subsidiary is reported, and then the portion that accrues to the non-controlling interest is subtracted out. So again, it parallels what goes on with our regular income statement. That means that in a sense we have two income to non-controlling interest entries, one for the regular income and one for the other comprehensive income. So this summarizes the results that we want to obtain. The question is, how do we go about making that happen? As has been stated over and over again, we can organize the worksheet and the elimination entries in any of a number of ways. Now, as far as the worksheet is concerned, we might want to go ahead and add a new section somewhere representing our statement of accumulated other comprehensive income. So this is going to be analogous to the statement of retained earnings. Again, for the statement of retained earnings, we have our beginning retained earnings plus income minus dividends equals ending retained earnings. We'll have to have something similar for accumulated other comprehensive income. We have our beginning accumulated other comprehensive income plus this year's other comprehensive income equaling ending accumulated other comprehensive income. Now, it doesn't really matter where in the worksheet we put this. I think it might be best, and this is what the textbook does, it might be best to put this down at the very bottom of the worksheet. If we were to put it up there next to the statement of retained earnings, it might get a little confusing, having too many things going on in the middle of our worksheet. So we'll go ahead and put it down at the bottom of our worksheet underneath the balance sheet. So again, here's sort of just the bottom third of our worksheet. We have the owner's equity section. We'll have common stock, accumulated other comprehensive income, and retained earnings. Now again, on the balance sheet, the common stock, the accumulated other comprehensive income, and the retained earnings, those are end-of-year balances. For retained earnings, the beginning retained earnings is put way up in the middle in the statement of retained earnings section. Now we have the new portion of our worksheet. Again, this would be at the very bottom. It's essentially our statement of accumulated other comprehensive income. We have our beginning accumulated other comprehensive income, which is what we're going to adjust. We add our other comprehensive income for this year. We subtract out the other comprehensive income that accrues to the non-controlling shareholders, and then we're left at the bottom with our ending accumulated other comprehensive income. Now, these bottom four lines sort of fulfill the function of two parts. First, we have what essentially amounts to our other comprehensive income statement. We have our other comprehensive income less the portion that accrues to the non-controlling interest. And then we place that within the context of the accumulated other comprehensive income statement. So if we were to apply the same structure to our statement of retained earnings and our normal income, Basically, we're putting the we're putting the income statement within the statement of retained earnings. So here, it'd be a little, it's already hard enough to present these worksheets um, in a succinct fashion. I think it would be even worse if we had a separate statement of other comprehensive income and a separate statement of accumulated other comprehensive income. So we'll just combine them into one single statement. Now let's go ahead and put some random numbers in here just to have some things to point at. Now let's assume this is an 80% owned subsidiary, and these are all going to be simply random numbers except as follows. First we have our common stock and our ending retained earnings, and I just chose those numbers at random. Next we have the beginning accumulated other comprehensive income. Again, these numbers are chosen at random except there's a relationship between the two of them. In this case, Little has $50,000 of accumulated other comprehensive income, so Big's accumulated comprehensive income is 80% of that, or $40,000. So I'm assuming here that Big doesn't have any of their own accumulated other comprehensive income. The only AOCI that Big has is their share of Little's. Next, the other comprehensive income. Again, I chose this number at random. Again, the relationship is that Big has 80% of Little's amount. So if Little has $30,000 of if Little has $30,000 of other comprehensive income, then Big will have $24,000 of other comprehensive income. Just as a little reminder, when the subsidiary reports other comprehensive income, the parent also reports other comprehensive income. And so we would have an equity method entry as follows. We'd have a debit to investment in Little for $24,000 and a credit to the other comprehensive income for $24,000. And so this is analogous to or similar to how the parent reports their share of the regular income. When the subsidiary reports their normal earnings, the parent debits investment in Little and credits investment income for their share of the ordinary earnings. Now we're doing the same thing for the other comprehensive income. And this is going to sort of come back to haunt us when we do our elimination entries. Just as we eliminate the parent's investment income against the investment in a Little account in our elimination entries, so too will we have to eliminate this as well. We're going to have to eliminate that $24,000 of other comprehensive income, and we're going to have to eliminate that $24,000 debit to the investment in Little. And now let's go ahead and complete the worksheet. Let's just focus again on the Big and Little columns. First, we run through our statement of accumulated other comprehensive income. Beginning AOCI plus other comprehensive income equals ending AOCI. And that's what gets transferred up to the balance sheet as ending accumulated other comprehensive income in the owner's equity section of the balance sheet. Now let's go ahead and see what sort of elimination entries can get us to our goal. Just to have some numbers to work with, let's assume that the beginning of year subsidiary retained earnings is $150,000, and I just pulled that number out of thin air. And so our S entry is going to have a little new addition. Again, we're going to eliminate the subsidiaries beginning of year common stock and retained earnings, as we always do. But we're also going to eliminate the subsidiaries beginning of year accumulated other comprehensive income. Again, accumulated other comprehensive income is an equity account, and in this S entry, we eliminate the beginning of year subsidiary equity accounts. So on the debit side there, we have a total of $250,000, and that $250,000 is going to be split 80-20 between the parent's investment account and the non-controlling interest. Now, note that, again, the subsidiary has $50,000 of accumulated other comprehensive income. After making this elimination entry, again, looking down at the bottom of the worksheet there, we've still got $40,000 of the parent's accumulated other comprehensive income. The other $10,000 of that $50,000 is now embedded in the subsidiary's non-controlling interest. So the entire $50,000 is being disclosed in the owner's equity section $40,000 of it explicitly as accumulated other comprehensive income. The other $10,000 of that has been added to the non-controlling interest account. Okay, let's go ahead and post those to the worksheet. And again, I want to focus here on the bottom half of the worksheet. So again, we debit common stock, we debit beginning retained earnings way up in the middle part of the worksheet, not shown on this presentation. And we go ahead and credit the non-controlling interest. Next, we have our next set of elimination entries, and the way the textbook presents these is in a single entry. We go ahead and eliminate the parent's other comprehensive income. Again, on the consolidated statement of comprehensive income, we're going to want to report the entire $30,000 of other comprehensive income, from which we will then subtract out or allocate away the non-controlling shareholders portion. So we're going to go ahead and eliminate the parent's other comprehensive income. We're going to go ahead and allocate $6,000 of other comprehensive income to the non-controlling interest. And then we're going to go ahead and again, we're going to add the $6,000 to the non-controlling interest. Again, if the subsidiary has other comprehensive income, then the non-controlling interest increases in value. And then finally, we credit the investment in the little account. It might be easier to break this into two separate entries. First, we have the one that essentially undoes the equity method entry that the parent does when they recognize their share of the subsidiary's other comprehensive income. Again, under the equity method entries, when the subsidiary reports other comprehensive income, the parent reports other comprehensive income and debits their investment account. So we're essentially undoing that. This is sort of like the I entry for other comprehensive income. Recall that the I entry in the format that we're using in the class, the I entry eliminates the parent's investment income. Now we're doing something very similar, eliminating the parent's other comprehensive income from their investment. Next, we have something that's analogous to the Inc. entry for the income to the non-controlling shareholders. In the INC entry, we allocate the non-controlling shareholders portion of the reported earnings. Now we're also going to allocate the non-controlling shareholders' share of the other comprehensive income. So again, the same basic structure as the INC entry, but now we're referring to other comprehensive income instead of regular old vanilla income. And again, we need to post these to the worksheet. So let's, I've posted them all in one fell swoop there. Let's go ahead and work through our worksheet now. And again, I want to focus on the bottom half of the worksheet there. The beginning accumulated other comprehensive income, we've eliminated the subsidiary's beginning of year AOCI, so we're left with the parent's beginning of year AOCI. We go ahead and add the complete other comprehensive income of $30,000. Then we deduct away the portion of that $30,000 that accrues to the non-controlling shareholders. So our ending accumulated other comprehensive income is $64,000, which we then transfer up to the balance sheet as ending accumulated other comprehensive income. So just sort of to summarize what we are reporting here. On the consolidated balance sheet, we are reporting $64,000 of accumulated other comprehensive income. And again, that is BIG's AOCI. Down in the income statement down below, we're reporting all $30,000 of other comprehensive income, but then allocating away $6,000 and saying of that $30,000, $6,000 accrues to the other non-controlling interest shareholders, leaving $24,000 for us. And finally, this is a display from General Electric's 2014 10K, or for the year ended December 31st, 2014. And let's focus on the middle portion of this illustration. We see other comprehensive income. So they've got $708 million of unrealized gains on investment securities. They've got $2.7 billion of other comprehensive losses from currency translation adjustments, and a bunch of other stuff going on. So total other comprehensive income or loss of $9.066 billion. Of that $9 billion, 14 million accrues to the non-controlling shareholders, which means there's 9,052,000,000 left to accrue to the controlling shareholders. So that's the portion, that's how it's presented on the comprehensive income statement. On the balance sheet, they'll be reporting only the parent's share of the accumulated other comprehensive income. Finally, note just for a moment, the second line down on this illustration shows net earnings or loss attributable to the non-controlling interests, $112 million. Combine that with the $14 million loss attributed of other comprehensive income attributable to the non-controlling shareholders, and we end up with the net comprehensive income or loss attributable to the non-controlling interests of $98,000. So $112 million of regular income less $14 million of other comprehensive losses, equaling the net $98 million of other comprehensive income attributable to the non-controlling shareholders. Wow, that was exciting. Yet there's more coming!